What's up, everybody, and welcome into today's video. And we got a big video for you today. So grab yourself a cup of coffee or your favorite beverage. We are getting into the nuts and bolts, how to buy and hold properties. We got a lot to cover in this video. Make sure you're taking notes, and I'm very excited to bring this information to you. So the name of this video, how to buy and hold and winning with affordable housing. The affordable housing sector is what we're most bullish on. This is what we're accumulating. Even our flips, everybody. The affordable housing sector provides the most amount of buyers, the most amount of exit strategies, and this is where we're putting all of our focus. You can make millions of dollars focusing in on the affordable housing sector. We're going to be getting into that in this video here today. And we're going to be talking about what asset classes what asset class, the affordable housing sector, what it is, why we're going after it, and why you should be going after this as well, and how you can do very, very well for yourself focusing in on this asset class, where to invest, the fundamentals of buy and hold, formulas for buying, Burr explained. We're going to be talking about no money down deals, and we're going to be getting into what cash on cash return is. So buckle up. We got a big one for you here today. So first off, the affordable housing sector, we specifically hone in on SFR or residential real estate, and I'm going to encourage that you do that as well. And that could be 1 to 4 units. It could be a single family house, or it could be a duplex, a triplex, or a 4 unit, especially if you're just getting started. The best financing is available for 1 to 4 units, specifically single family houses. They're the easiest to do, easiest to manage, and I want you getting positive momentum behind you when you're starting on this. There's the most amount to choose from with the SFR asset class. I don't want you guys getting too big for your britches and I'm not here to limit your goals. I'm just letting you know, if you're just getting started, I don't want you going out there raising all this money and trying to do a syndication and whatnot. We'll get there. RJ and I do this kind of stuff too, but let's just start out. Let's learn the single family business, pick up a couple rentals under your belt. If you want to expand this thing, we're here to help you with that as well. But affordable housing is a great place to start. And this is where you're dealing with an ARV. If you're not familiar with what that is after repair value, the value of the property between 100 and 250,000. This is going to provide the really the bread and butter of what we're investing in. We love these assets. And they provide the most exit strategies, especially the single family properties. You can do creative exit strategies with tenants. You can do rent to own. You can do land contracts. We have experience with all of this stuff, but you can't do it with an apartment. Let's pretend you bought an apartment complex, 16 units, 25, 50 units. You can't do a creative type of exit strategy with just one of the units, right? You can with one single house, but if you own multiple units, you can kind of get creative with one unit and do something like that with one tenant and do something different with somebody else. You're just pretty much leasing those out. So a single family houses provide the most amount of exit strategies, the highest demand. You know, think about, put yourself in the shoes of anyone who's renting a property. Do they want, an apartment where they don't have a yard and they're just separated from their neighbors with a piece of drywall? Or do they want their own living space? Do they want their own house? Of course, they demand, a single family house is in more high demand than an apartment. Best financing, which I already touched on. We're going to be doing a whole video. The other 2 videos that I got for you guys, by the way, is lead generation, seller generation, finding deals, and funding deals and negotiating deals. We got some more stuff coming for you, but we're going to be talking more about financing. But I'm here to let you know the best financing comes from residential real estate, 1 to 4 units, easiest to manage. Provides maneuverability. Let me just touch on that. If you owned 100 single family houses, let's say you own 10 single family houses or a 10-unit apartment building, and let's say you ran into a situation where you needed to create some cash. Well, if you own 10 houses, you can maneuver. You can maybe sell 2 of these assets, raise some cash for yourself, keep the remaining 8. Well, if you owned a 10-unit apartment building, you can't just sell off 2 of the units. You got to sell the whole building. So sometimes in business, you have different cash requirements and cash needs. Maybe you need to raise some cash for a new, bigger deal or something like that. Well, with 10 individual assets, you could maneuver if needed and provide that flexibility for you, which you cannot do with a multi-unit apartment building. And then note, multifamily is the best way to scale, though. I will tell you that. I'm most bullish on the single family in the residential space, and especially for you guys, especially a lot of the new people. Now, if you want to get as big as you possibly can, as fast as you possibly can, multifamily apartments is the way to do that. You can't touch that, right? Multifamily is way more scalable, but in my opinion, it is actually better to stick with the single family assets. Where to invest? We want to be in places with landlord friendly laws. I don't know if you've seen on social media, there's these crazy videos where tenants kind of take over a house, they don't leave. Well, the owner can really get screwed depending on the laws in the jurisdiction where they are investing. With that being said, you want to be in landlord-friendly places where you could easily remove somebody who's not supposed to be there or easily evict somebody if they're not paying. We want to be in working class areas, a good mix of renters and owners. We want to avoid war zones. They look the best on paper. You're going to sometimes see these deals coming through. Hey, I could get this thing for 20 grand. Wow, what an amazing price. Well, it could turn into a real project for you, and it could turn into a disaster, to be completely upfront. I want to see you guys in bread and butter working class areas, solid home inventory, solid home stock. We don't want to be dealing with war zone type of situations. And avoid older properties. I'm going to encourage that you guys avoid properties built prior to 1950. If you can, go, avoid properties really prior to 1970. The newer, the better. You're going to have better building materials and it's going to be less work. I don't want you guys taking on major rehabs that really can slow you down. The construction aspect of this business, it could be very risky. And, I want as little rehab as possible when I'm looking at these assets in these solid working class areas. And I just wanted to give a side note, stick to 3 bedrooms as a minimum. Also avoid condos and townhomes, avoid HOAs altogether. We recently had a deal blow up simply because the HOA was in so much debt. The lender we were going to use to finance this thing, we were going to, pick this up as a flip, as a matter of fact, but we couldn't even close the deal. The funding partner did some research and they noticed the HOA was in a big world of trouble and they didn't feel comfortable funding the deal. First time in my career that's ever happened. Just avoid HOAs altogether. Let's stick to that rule. Fundamentals of the buy and hold business. So we want to be around the ARVs between 100 and 250 because these are going to provide you the strongest rent to value ratio, i.e., let's say you're picking up a property, the value is 150,000, 1% of that would be 1,500. That's like a solid rent to value ratio. If you get too big numbers as far as the after repair value, I mean, we're doing a flip right now on a property down in Cincinnati, Ohio. It's an $850,000 property. It's a novation, as a matter of fact. So we didn't have to raise any money on this. And that's great. It's wonderful. But it would make a terrible rental property because, at some point, the values increase faster than what you could actually get in rent. Maybe we can find somebody to rent this property for $3,000 a month, but could you imagine buying an $800,000 property? Your loan payment on that would be $10,000 a month. You'd be losing $7,000 a month. We want to stick to this rent to value ratio that will allow you to produce a positive cash flow. That's why we love those ARVs. 100 to 250 works very well. And the rent is going to we're going to get deeper into something called DSCR. It's debt service coverage ratio. I'm not here to get too fancy with you guys. Just know this. The rent needs to be minimum 1.25% of the PITI, the payment. Now, PITI is the principal, interest, taxes, and insurance. When you're acquiring these rental properties, you're going to be using 30-year financing, 30-year mortgages, and your payment on that mortgage is going to be for principal, interest, taxes, and insurance. That's PITI. So let's pretend that your PITI payment is $1,200. Well, you could just multiply $1,200 times 1.25, and you're going to get $1,500. In fact, it's oftentimes the lending requirements for the lender who's giving you the 30-year loan, they're going to want to see minimum 1.25% when it comes to that. Next up, we got some formulas here for buying rental properties. We're going to be talking heavily, and you're going to hear me talk about this quite a bit, all in. So we want to be all into our deals for 75% or less. I should say 75%, 80% maximum or less. So the all in, what does all in mean? All in is your purchase price, your purchase amount, your all in purchase price and costs, plus your rehab. That number is your all in. So when you hear me referring to all in, that's exactly what I mean. You're going to want the rent 1.25% of the PITI. And the core four of real estate, anytime you're kind of analyzing a deal, there's four things you need to know. You're always asking this when you're looking at rental properties. What is the purchase price? What is the rehab? There's your all-in number right there. Okay. What is it going to rent for? You got to make sure the rent is going to more than cover your financing costs. And what is the after repair value? Because the lenders are only going to lend you 75 to 80% of the ARV. So when you're analyzing a deal, you're looking at a potential rental property, you want to look at properties where you could be all in. So you're looking at the ARV. Let's pretend it's worth, 200. You want to be all in for 75 to 80% max of that 200. So 75% of 200,000 would be 150,000. So let's pretend you can buy it for 100 and fix it for 50. That would fit the 75% all in. Okay? I'm pushing it a little bit with the 80%. I don't want you guys going above 80% all in. Okay? So just take note of that. We talk about the core four of real estate quite a bit. Whenever we're analyzing any type of deal, we are looking at the purchase price, the rehab. That's our all in. Then we want to know the rent. What is this thing going to produce as far as income? And then what is the value? Because these lenders are only going to give us 75 to 80% of that value. So you need to know that when you're underwriting or evaluating deals. Let's talk about the BRRRR. BRRRR stands for BRRRR, buy, renovate, rent, refinance, and then repeat. This is a very repeatable and scalable way to build your portfolio, and we have done this umpteenth times, everybody. This is how we've done it. This is exactly how we've done it. And off-market properties work the best simply because it is very common to get a much better deal on an off-market property than something on market. Now, in a future video, we'll be getting into where we're finding these deals. We got that covered for you and how to negotiate these deals. But remember, you want to be all in for 75% or less. A huge part of that all in number is what you're paying for the property. You got to get these things as cheap as you possibly can. It's going to serve you well in these deals. So purchase and rehab, a typical BRRRR deal in our world here is we're finding a great deal on a property, ideally off market. You get the best deals. And you're going to fund, then you're going to borrow purchase and rehab money, okay, from a private lender or it could be a hard money lender or just somebody who's willing to give you the money. This is what you do. You borrow from a lender acquisition and rehab money. You buy it, you get it fixed up. After it's fixed up, then you go and refinance this deal because you already own it. You bought it and you rehabbed it with private money or somebody else's money. Ideally, 100% financing, ideally. And if you kind of coach with us and work with us, we're going to teach you how to raise all the money that you need for your deals. But you buy the property, you fix the property with somebody else's money. Now that it's fixed up, you get it rented out. Then you take it to a normal traditional bank type of lender, and they're going to give you what is called permanent financing, i.e. a 30-year fixed rate type of mortgage, right? A private lender funds the acquisition and the rehab, and then a permanent lender, 30-year lender, comes in, refinances it, that pays off your private lender, right? And now you're left with the property. You got a good loan, good loan payment, a low payment on this, producing positive cash flow. That's a typical BRRRR. So I want you to wrap your mind around that. And you're always finding out anytime somebody sends you a deal, you guys are going to be attracting so many deals. You always want to know the same four things. What's my price, right? What's the rehab? What's the rent? And what is the ARV of this property? That's all very important. So with BRRRRs, the deeper the discount that you get, you want to be as far below 75% as you possibly can. So the deeper the discount, more below 75% of your all-in, that's cash to you. So back to a quick example here. Remember, let's pretend the lender is only willing to give you the permanent lender or the refi lender is, and this is very common and very typical, they're only willing to give you 75% of the after repair value. So let's pretend that you got a property and the ARV is 150. And let's pretend you bought it, you're all in for, let's say you bought it for 80 and you fixed it for 20, so you're all in for 100. Just an example here. I want you guys wrapping your mind around this all in, right? So it's worth 150. You got a great deal on it at 80. You borrowed from a private lender, the 80 plus the 20 to fix it. You're all in for 100. Well, this permanent lender then is only going to give you 75% of the ARV, 75% of 150 is 112.5. That 112,500 comes in, pays back your private lender for 100, and that remaining money, that $12,500 is cash to you. And it's tax-free because it's a loan, it's not income, it's money that needs to be paid back. But now you owe to a permanent lender, a bank lender, 112,500 on a property that's worth 150,000. So you got nice equity here. And since you used a private lender to purchase and rehab it, you're into this deal for none of your own money. The private lender got paid back on that refinance. You collected cash at the time of that refi, and you're still left with the property that has equity and a positive cash flow. That's picture perfect right there. That's how you do this thing with none of your own money. So you find, here's another example. You find a deal for 60. The ARV is 150. Let's say the property needs 40K in rehab. You guys already see where I'm going with this. You get a private or a hard money loan for 100K. That gives you all the money that you need to purchase and fix it. Okay? So you're all in for 100. The refi lender is going to give you 75% of your ARV, which is 150. Back to our 112.5. The permanent lender is going to give you 112.5. You pay back your private lender the money they gave you, and then you're keeping that 12,000 or 12.5 cash at close. You own the rental property, and it's infinite return. We're going to be getting into calculating your returns on these deals. Well, the way you calculate any type of return, whether it be a stock or anything, is you got to look at how much money did I put out, and then how much money did I get back? What is my return on the investment that I put out? Well, in this example, I'm teaching you guys how to use none of your own money. So you didn't put anything out for a nice $12,000 or $12,000 $12,500 payday at the time of refi and a positive cash flow. Well, if you're collecting $12,500 at this refi and $300-$400 a month in positive cash flow, it's infinite return. The way you get infinite return is by using none of your own money, because all return on investments is what did you put out and what did you get back? If you didn't put anything out except for your time and energy, but now you're keeping this asset and you got paid a lump sum on the refi and you're getting a monthly cash flow, your return on investment, since your investment is zero, any dollar that you receive above zero, it is an infinite financial return for you. This is how you build real wealth. It's all about getting great deals. It's all about using other people's money to buy these things and fix these things and then refinance these things. And if you get them cheap enough, which we're going to show you how to do from off-market sellers, you can actually collect money when you refinance this property. Bada bing, bada boom. We are rolling now. And then you just rinse and repeat, rinse and repeat, rinse and repeat. Next thing you know, you're getting paid to buy properties here. Essentially, that's what this is. You are rocking and rolling in this business, and you are building financial freedom that you deserve. I'm here to let you know you are passing this information and you're passing these assets on to your children or your legacy. You're building real wealth. This is what they don't teach you in school, everybody. Using other people's money to acquire assets, getting paid to acquire assets, and creating that monthly passive cash flow. What is cash on cash return? Well, I just told you what a return on investment is when you, what did you put out and what did you get back? Okay. Well, I gave you an example on no money down deals, but sometimes we're just straight up using permanent financing to buy a property. And when you're buying properties on market, which many of you will, and there's great deals to buy on market, and not all of you want to do the off market thing and raise the private money, and that's perfectly fine. Sometimes people in our Done For You program, they just work with a deal finder. We get them pre-qualified with one of our bank lenders right off the bat, and they're perfectly happy putting down, let's say 25%, 30% as a down payment. They got some cash. I just want to put this money down and get a great property in a great area that's going to produce a positive cash flow. Well, let's teach you what your ROI is when you put a down payment down on a property. Very common. So remember, the lender's only going to give you 75 to 80% of the ARV. Let's pretend that you found a deal and you're going to put a 25% down payment. So let's say the ARV, the after repair value, is 150,000 that you're buying direct from the seller. Let's say it's on market. Say one of our deal finders found it for you, whatever, and they're going to give you 25, you got to put 25% down to acquire this property. So that's 37,500 for your down payment. So now they're going to loan 112,500, which is just 150 minus your down payment. You're getting a loan for 112,500. Let's just pretend you're getting a 6.5% 30-year mortgage. Your principal and interest payment, your loan payment is 711.08. Let's say you throw in the taxes and the insurance, and let's say your total PITI payment for this example is $1,100 per month. And let's say you're collecting $1,500 per month. It's a nice little 1% rule. If you noticed, I did it that way. So you got an ARV of 150, 1% is 1,500. There's a nice little, I love these affordable housing 1%ers, work really well. Let's say your PITI, principal, interest, taxes, and insurance payment is 1,100. You're collecting 1,500 per month in rent. So your net positive cash flow for this example is $400 per month. Now take your $400 per month. How many months are there in a year? You got 12. So take your 400 times 12, that's $4,800, right? Now take your $4,800 because what we're calculating is an annual cash on cash return. Everything is really pretty much, you're looking at things on an annualized basis, right? So what are you making on this per month? First off, what did you put out? You put out 37,500. What are you bringing in? You're bringing in $4,800 for the year. So take your $4,800 of your annual net income, divide it by what you put out of the 37,500, and that gives you 12.8% cash on cash return. You're getting a 12.8% return on the $37,500 that you put out. This is what cash on cash return means. You are calculating the return on the money that you are putting into the deal. You're not calculating a return on the total asset. You're only calculating the return on the money that you put into the deal. So we look at it from every single angle. You know, we're buying these a no money down deal. Is there no money involved in the deal? In a no money down deal? No, it's just not your money. No money down deal means that you're using somebody else's money. We're experts at raising private money, using hard money, bridge loans. We do this all in our coaching environment. We are very big into private money, and we break it all down for our coaching clients and whatnot. We're experts at this stuff. But this is a more common example. You know, if you're just buying something that you're putting a down payment on, you're going to want to know what that ROI is on the cash that you put into the deal. And you're in this example, you're getting 12.8% on this particular deal. So with that being said, everybody, we got more to come for you. This is just a very good little class about buy and hold, the difference of a no money down deal versus something you're putting a down payment on, how to calculate your ROI on the down payment if that's the way you're purchasing. Next up, we're going to be getting into, you know, what we call lead generation and lead conversion. We're talking about where do we find these motivated sellers, right? And then how do we negotiate with these motivated sellers? This is what I do all day long, everybody. I can't tell you. We're writing new deals every single week. It's a very fruitful business. I can't wait to teach this stuff to you. It's actually what I'm most excited about. I think it's probably what I'm best at. If you watch me on social media, I'm constantly posting recordings of me negotiating with sellers. And in our coaching community, last plug on that, but I provide all my full recordings and all my full calls. So for our coaching clients, you can literally listen to my calls from start to finish every single week. I'm writing new contracts right over the phone, and you guys are going to learn kind of the basics and the framework on finding these deals, negotiating these deals. Then we're going to get into the financing piece. everything from private money to bridge loans, like I talked about, and kind of hard money and permanent financing. We got more to come on that. So, everybody, congratulations on being here. This has been extremely fun for me, and I'm very passionate about this stuff because I love it. And I will see you all on the next video.